So should we buy the dip or should we sell before the bear market? It's a question that I've been asking myself over the course of the past couple of days as global equity markets begin to sell off. The S&P 500 has had its worst start to the year for the past 5 years and is currently down 8.3% year to date. The Nasdaq is already in corrective territory and down 13% year to date, but it's not just US financial markets that are selling off. The FTSE 250 is down 6.8% and the Stocks Europe 600 is down 3.17%. So regardless of where you're putting your money right now, whether it's in Europe, America or UK equities, the chances are there's a high possibility that your investment portfolio is currently in the red this year. Even some of the pandemic's biggest success stories have even started to crater this week, with the likes of Netflix stock plunging 20% in a single day after a disappointing earnings report, along with Peloton stock which also dropped 20% too in a single day after a halt on production due to a lack of demand, and is now currently down 84.6% from all-time highs last year. But with the high possibility that the worst is yet to come, what's the best course of action for us as investors? Well, let's discuss it, guys, but before I do so, my name's Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below, as well drop a like on the video, guys. It really helps out the channel. With that being said, let's dive straight into it. So market corrections or bear markets are two terms that no investors want to hear. Yet they are both becoming a very real possibility in 2022, especially if you've been paying attention to the news over the course of the past few days. So let me set the scene for some of the newer investors out there. If we're going to explain how equity markets perform over the course of the long term, here is how I'd probably explain it to you.
Sometimes it may be good, sometimes it may be shit.
2021 was one of the best years for investors over the course of the past decade, with the S&P 500 returning 26.8%. But then on the other hand, the stock market hasn't always been so good to us, and actually back in 2018, the stock market actually dropped just under 10%. It's just part and parcel of being an investor. On some years we'll get some great gains within the stock market, but then on other years it probably won't be so good. But the question is, what's the outlook for this year? Another big year full of gains, or a year where the stock market could certainly take a tumble? Well, I think for me personally, the latter is likely going to be the more likely scenario. With the stock market correction already on the cards, I think it could be probably somewhat unlikely that we'll see a huge recovery throughout the course of the year and actually see full-on positive returns for our investment portfolios for 2022. And the reason why I think that comes down to three core factors. And those three reasons are high levels of inflation, interest rates starting to go up, and quantitative easing starting to reduce. These three main factors are the main underlying reasons why I'm expecting to see slower economic growth this year, and as a result I think that will have a knock-on effect to businesses and earnings will start to slow down as well, and therefore stock returns will certainly slow down, if not decline, throughout the course of the year. And the truth is, many of these economic issues in which we're facing into are already starting to be priced into the stock market. But sometimes, naturally speaking, markets can get it wrong and actually go on to price too much downside into the market before it all kind of plays out. If you think about the market crash of 2020, the market went on to crater about 35%. And that was well before we even knew the full impact of the pandemic. It was before case numbers started to grow, and it was before kind of global lockdowns and restrictions and supply chain issues really had an impact on businesses. But before you knew it, the market went on to recover within 5 short months, making it historically one of the shortest bear markets in history. So whilst we're not quite facing into a bear market just yet, which for those of you guys who don't know is a decline in stock market prices to the tune of 20% or more, with the average bear market lasting roughly about 13 months, if we do end up in that case scenario where the stock market has declined that 20%, well, in that case, we could be expecting to see our portfolios decline gradually throughout the course of 2022 and perhaps even into 2023 as well. Now, whilst we're on the topic of historical data, I thought we could possibly look back at some older data in order to make some assumptions as to what could possibly happen throughout the course of 2022 by looking back at some similar economic conditions that we saw back in the day. So let's take the inflation debate to begin with, because as we all know, US inflation is absolutely sky high and actually at its highest point since 1982. So let's take a little bit of a deeper look into the inflation around that period of time and also compare that to the stock returns as well. Well, to give you guys the data, back in 1980 we actually had a peak inflation number of 13.55%. before inflation actually started declining in the years thereafter, before then actually going on to just completely flatten out and provide some kind of normal levels of inflation. But the question is, what happened to the stock market during that period of time? Well, between the years 1976 and 1980, inflation ran from 5.74% right the way up to that peak of 13.55%. And during that period when inflation was rapidly rising, the stock market actually did go on to decline and actually enter into corrective territory, declining 10.9%. But as inflation peaked at that 13.55%, guess what happened? Well, as you'd probably expect, the Fed then went on to increase interest rates, which I guess kind of brings us to some kind of comparable circumstances in which we're facing into now. The only difference being the Federal Reserve actually increased interest rates to 20% as opposed to what the Fed are potentially going to look to do now, which is probably increase interest rates from 0.1% to probably about 0.25%. But back in the day, as inflation started to become under control because the interest rates went up and it made money more expensive to borrow, it was certainly one of the economic catalysts that saw the stock market go on to crater 33.16% between November 1980 and July 1982. So guys, we can certainly draw some parallels in terms of the stock market conditions which we're facing into now compared to the stock market conditions which were seen 40 years ago. We're certainly still in a period of time where inflation is continuing to rise, and it looks ever more likely that the Fed will go on to increase interest rates in order to curb the level of inflation. And I think the reality is, if rates do go up and they start to go up quite a significant amount, I think we'll see the stock market sell off further. The only saving grace I think for investors right now is the simple fact that interest rates are simply so low. It's certainly not going to be the case where interest rates fly up to 20% like they did back in the 1980s, because that would probably create more problems than not. And even if the Federal Reserve went on to increase interest rates on 3 separate occasions throughout the course of 2022, well, assuming that they do 25 basis points perhaps per rate hike, then by the end of 2022, interest rates will only actually be at 0.85%, which is still very, very low. And it makes money still pretty cheap to borrow. I think the key here is between getting a balance between kind of curbing the rate of inflation and not rising interest rates too high. So where do we as investors go from here? Well, the next thing to pay attention to is that there is an FOMC meeting taking place early this week. And the meeting taking place will certainly tell us the near-term outlook for monetary policy and whether the Federal Reserve have actually decided to increase interest rates or not. And as a result, it will certainly give us a little bit more of an indication as to what to expect throughout the rest of the year as well. So as investors, the overriding question here is, well, should we look to buy the dip now, or should we sell heading into a possible bear market? Well, for me personally, as a long-term investor, and I'm going to continue to reiterate this point, this now is a good opportunity to just simply continue to cost average your way into the market. Yes, it's certainly going to be painful in the moment, because for me personally, I've seen my trading 2-on-2 investment portfolio absolutely tank over the course of, well, since the start of the year pretty much, with thousands and thousands of pounds being lost off the total value of that portfolio. But nonetheless, I know for me personally as a long-term investor, the more the stock market falls right now, the more aggressive I'll likely be in order to cost average my way into my investment portfolio in order to capitalize the most over the course of the long term. Let's kind of think about kind of the worst case scenario, and let's say we end up in a bear market for about 18 months whilst we go through this transitionary period. What I kind of think in the back of my mind, regardless of how long this bear market goes on for, whether it's, you know, the average, which is about 13 months, or even if it's 18 months, or perhaps even 2 years, I think for me personally, what I have to think about the most as a long-term investor is, what will the stock market look like 5 years into the future? And based on historical data, you can suggest that it's going to be highly likely that 5 years from now, stock market prices will be higher than what they were today. So because of that, there is return on investment to be made. So I think for every investor out there right now, especially if you're a longer term investor, it's certainly going to be quite a bit of short-term pain, but perhaps with a long-term gain with long-term payoffs. So for me, unless you are certainly needing the money from your investment portfolio right now for whatever reason, you should never look to sell during a bear market. And instead, it should be a perfect opportunity to do the exact opposite and load up on your investment portfolio. Because I think specifically during this bear market in which we're likely heading into, it will be a huge shakeout of investors. And I think this will be a massive transfer of wealth for the individuals who are patiently waiting in the stock market, actively putting money into the stock market as stock market prices fall in value, in order for you to capitalize from what could be a hell of a lot of of growth over the course of the next 5 to 10 years. So with that said, guys, be sure to let me know what your thoughts are on all of this stock market stuff down in the comments section below. And if you guys do want to learn a little bit more about creating the perfect investment portfolio during these harsher economic conditions, then be sure to click on this video here. As well, guys, if you did enjoy this video, be sure to drop a like on it, subscribe to the channel if you're new around here. With that being said, I'll see you over in the next video.